Well, good morning and welcome back to the Broadcast Retirement Network's BRN Sunday podcast. I'm Jeff Snyder, your host. I'm going to be joined by members of the media, academia, and financial services as we go around the globe to discuss and analyze all the issues related to retirement markets, technology, personal finance, so much more. We've got another great show for you this week, so sit back, relax, and enjoy this episode of the BRN Sunday podcast. Well, let's kick things off with a look at technology. Joining me on the line is Daniel Klein, Senior Technology and Consumer Products Reporter with The Motley Fool. Hi, Dan. Welcome back to the program. Great to talk with you.
Hey, Jeff. Nice to talk to you.
How was your week?
I am being held together with chloroseptic and tape at the moment. We have a bunch of people on vacation, so I normally broadcast maybe 2-3 on an outside day, hours a day. I did 5.5 hours yesterday.
Oh. So how your voice is scratchy? I mean,
it's a little bit ragged, and I've got this interview, and then I'm doing I think about 3 hours today. So
wow.
Tomorrow, but as of noon on Friday, I don't have to work again until noon on Saturday, so I can not talk for 24 hours.
Yeah, good for you, I'm sure. And you know what? I bet you your wife and son appreciate that too.
My wife does, certainly. My son, I think, is afraid to ask me any questions because he knows I am parsing my words out.
Oh, okay. Well, let's jump in because one of the biggest stories of the week and the weekend was TikTok. And I know this is we're not going to talk about the political implications or the national security implications, but we want to talk about Microsoft's potential acquisition. What do you got there?
Yeah, so TikTok is in a situation where it's essentially being forced to sell its U.S. operations. It's more than U.S. It's Australia. It's New Zealand. I think there's one other country in the mix there. And it's over data privacy concerns. It's you mentioned there's political issues associated with it. The circumstances of it are very strange. That said, Microsoft stepped up and said, hey, we'd be interested in buying TikTok. And it's an interesting deal because I've read a lot of articles on, well, how do you value TikTok? Well, TikTok has a huge audience, over 100 million people in the US. That would value it about where Snapchat is, which is about $33 billion. That's been a pretty stagnant stock. But it's a forced sale, so maybe it's only worth $10 billion. That is literally the reporting I've read has it valued somewhere between $10 and $33 billion. That is a bit of a span.
Yeah,
and
to say the least.
Yeah, and there were rumors Apple was involved, was interested, and Apple has come out and said they're not. That doesn't mean they're not backdoor having these discussions as well, but it looks like it's Microsoft's for the taking, which gives them some leverage. But Jeff, I'm not sure I like Microsoft as the owner of TikTok.
So I want to ask you first, before I get to why. I know you teased me with that, and I know I have to ask you why. But how does TikTok make money, Dan? They've got a lot of social influencers. People are dancing. We've talked about it on the network about people getting financial advice from TikTokers. I don't know what you call them, but I'm going to call them TikTokers. How do they make money?
It's advertising. Mostly it's, just like on Facebook, ads between the videos. In some cases, there may be like brand placements, So, yeah, but they're an advertising play, which is a business Microsoft has struggled with over the years.
Yeah, I know, and we talked about that with the robotization of MSN Money. Now, Dan, I want to go back to the question you teased. Well, you didn't ask the question, but I'm going to ask it. Why could this not be a good fit for Microsoft?
Microsoft's history of acquisitions hasn't been great.
And accusations.
So we're doing this over Skype. We're like the last two people on Earth using Skype. Even Microsoft, which has Teams, doesn't embed Skype in Teams. They created their own video conferencing for Teams. They spent a lot of money for that, billions of dollars. They spent $8 billion buying Nokia to bolster their Windows Phone division. Jeff, do you know where the Windows Phone division is now?
Probably in the trash can.
It's defunct. It doesn't exist. Now, they've done a decent job with LinkedIn. They bought LinkedIn and they set it aside. This is a lot of money for a company that, except for Xbox, had largely been moving out of the consumer-facing business. And what's not going to come with this acquisition is Kevin Mayer, the former Disney executive who is the CEO of TikTok globally, but also the COO of ByteDance, the parent company. Now, I don't know if he'll leave ByteDance, but I'm guessing he's not coming to be a division head for Microsoft. So to me, nothing Microsoft has done has shown that they can operate a product that's aimed at like 12-year-olds. Like, it just seems like a very bizarre fit.
So it's aimed at 12-year-olds, but there are a lot of, I mean, how many, what do you have a feel for the demographics? I mean, I don't use TikTok. I don't dance on it. Maybe I should. My wife tells me I have really good dance moves, but who uses this platform?
It skews young, and they're not public, so we don't know. But that said, based on the videos there's some families doing things together, but it's definitely younger people. It's closer to Instagram than it is to Facebook.
And then what's the implication here, Dan, with, remember YouTube? Do you remember YouTube? I mean, YouTube was all the rage. And is that still the rage, or are people now?
Yeah, no, YouTube is the entrenched winner, but there's sort of a space for these short form videos, and everyone's trying it. We've talked about the disaster that is Quibi. You remember Vine, which was purchased by Twitter and then eventually shuttered. There seems to be a place in the market for sort of these organic spreading, shared a lot, watched by tons of people, short form videos. And that's where TikTok, and there's a number of other players in this space. None of them are successful, but in theory, if Microsoft buys TikTok and the TikTokers don't like it, or the influencers don't want to come along, they could go to Facebook's Reels platform, which is on Instagram. They could go to some of the many struggling competitors for this. So I don't know. I don't like this deal at all. I don't like why it's happening. I, there's no way to talk about that without politics, so I'm not going to talk about it.
Yeah, and it
But
doesn't make any sense to talk about that because we're not going to get any resolution to that. But Dan, in terms of the sell date, do they have a date that they have to be sold by?
so right now they've been given 45 days through September 15th to negotiate until, in theory, the president intends to ban TikTok in the U.S. In practicality, there's a lot of legal injunctions that can be filed, but frankly, if it looks like a deal is going to get done, Satya Nadella is going to call up and say, "Hey, here's where we are. Give us 15 more days." Like this deal isn't going to have an arbitrary deadline if it looks like it's progressing.
Okay, so I want to shift gears. I mean, it's so interesting to hear about this, and something that I don't even use. I mean, I don't consider myself someone who follows quote unquote influencers. I don't know what it takes to be an influencer, but clearly I am. I am definitely not under the definition of influencer. But something else that we've talked about, Disney Plus, and we both love the platform. We love the Mandalorian, and season 2 is coming up. But Disney Plus is doing something very interesting with Mulan. What are they doing, Dan?
Yeah, they're doing something interesting, and they're doing something that appears to be flying by the seat of their pants, which is very un-Disney. So basically, they've come out and said, we keep pushing Mulan back, but we've invested $200 million in this movie. We already spent $100 million on marketing it. We don't know when theaters are going to open. So here's what we're going to do. We're going to make it a premium tier on the Disney Plus network. So when they first came out, they said, you're going to pay $29.99 for this, and you're going to get a 48-hour rental. They later turned around and said, no, you will always have access to it as long as you're a Disney Plus subscriber. Of course, eventually it will move to the free tier. They are, of course, not going to tell you when that will be. And frankly, how many people buy this may determine when this will be. I actually think this is pretty brilliant because, Jeff, I know a lot of people that have kids. They're bored. A lot of activities are closed. Maybe they're seeing one friend, but they're not seeing their groups of friends. They're not having their sports. They're not having all their activities. They rented Trolls World Tour. They rented Scoob, the Scooby-Doo movie, and those were $20. This is a live-action remake of Mulan. I could argue that it has some adult appeal. It doesn't have any appeal to me, but I could see a ton of families sitting around. My colleagues laughed at me. There are about 56 million Disney Plus subscribers as of June 27th. I'm guessing that number is closer to 65 million because Hamilton was released on July 3rd, and that pushed a lot of new members, but that was outside the reporting date for their latest quarter. I predicted that half of them, that about 30 million people are going to pay this money to rent it, and that would be $900 million. My colleagues laughed at me. They said there's no way that will happen, and they did point out, and I do think this is true, that people are going to have some maybe unsafe watch parties. They're going to have friends over to watch this. Maybe some people have some safe ones, rent a blow-up screen in the backyard, be socially distanced. But I think this is going to be a blockbuster because remember, when Disney releases it this way, it keeps more of the money, and that's a major benefit.
So, okay, I get the whole. So I want to kind of take this to the macro, which is all these kids, we don't know if they're going back to school, and if they are going back to school, they might not be going back to school in certain areas of the pockets of the country where there is a rampant virus, and that's still to be determined. We talked to Dan Domenech from the AASA on last Saturday about that, a week ago Saturday. But these kids are, I mean, think about the impact to the social development for these children, right? I mean, as a father, Dan, a parent, I mean, there's got to be some concern there if you can't get your kids out to see other children and to learn the things that you pick up when you fall down and you guys rib each other and all that kind of stuff.
So I've been letting my son see one friend. He has one friend who I trust, the parent. They play Xbox together. It's reasonably safe. But that said, there's some risk there. I'd like to see my son go back to school on some sort of like rotating half the kids basis. I'm not even sure what that would look like, or frankly, logistically how it would work. Because I went from working a not set schedule to working a set schedule, and just getting him to the bus stop and picking him up would be especially difficult compared to normal times. That said, so much of his interaction with his friends is digital anyway. I'm not sure that changed that much. It's interesting. He hadn't had go over to a friend's house. He hadn't done that all year. And then when he wasn't able to, it was something he really wanted to do, and he was endlessly mad about it when we wouldn't let him do it. So I think it's going to be different for every kid. I have a cousin who has leukemia, and his treatment works, but he's immunocompromised. So his teenage daughter, who's a year younger than my son, so she's 15, she can't do anything because it puts her father's life at risk.
Right.
And she's, as you might imagine, not super happy about it. It's a tough question.
Yeah, it is a tough question. But going back to this Mulan thing, and I guess the reason why I bring it up is, people are starving for more content. I think you and I talked about Netflix buying, or I talked to somebody, maybe it wasn't you, Dan, but Netflix buying more off-the-shelf content for from Viacom as an example, because people are they're done consuming what's been on Netflix. They're home. And I find it interesting that now Disney is going to release Mulan. They made a considerable investment. Now they're going to charge for it in this pay tier. Do you think that could possibly work against them?
So they're saying this is a one-time test. They're being careful to not be provocative to movie theaters, even though this is a provocative move. That said, Comcast, their rival, is being incredibly provocative and has negotiated with AMC, instead of the traditional 70 to 90-day window, a 17-day window. The other movie theater companies are saying, no way are we going to agree to that. This is Disney's test to see, geez, if we took premiere content, will it still get a premiere audience? And they know the numbers. Maybe it only needs to be watched by half as many people to be viable. Maybe if they did this 4 times a year on Disney Plus, a $1 billion box office movie would only make $500 million, but maybe they keep 90% of that instead of 60%, and maybe an added 10 million people subscribe to the platform. They can do all that math to know what the value is. I don't think you're going to see the next Avengers movie on Disney Plus first, but I do think you might see some of these tweener movies like Mulan. That's going to be a big hit, but it's not going to be the biggest movie of all time. This is absolutely a test.
Yeah, it's interesting. It's going to be interesting, I think, from my perspective, what people's preferences are. We're going to be learning more about personalization and individual preferences. That, to me, is fascinating because as someone who, you and I both create content on a daily basis, and some for hours and hours like you do, and it's going to be interesting to see how people consume that, what the appetite is, and what the appetite is for paying it. So more to come on that. Dan, well, we're going to have to break things off, but really appreciate you coming on the program this morning, talking about this really important topic, and I'm looking forward to having you back on the network on Tuesday to talk a little bit more tech.
Thanks for having me. I'll see you then.
Bye-bye. Welcome back. Now time to talk personal finance. Joining me on the line is Mari Backman of The Motley Fool. Hi, Mari. How are you?
Doing okay, Jeff. How are you?
I'm doing okay. I know our area, you and I both live in New Jersey, and the greater New York area has been hit hard. Was hit hard by that storm. How you all making out?
We're doing okay, despite actually not officially having power or internet. Luckily, we invested in a generator for our home a few years back because power outages are actually pretty common out here.
Hmm.
You can chalk it up to poor infrastructure, I think, more so than anything else. So I'm glad we made that decision because we've basically been running on generator power, and if not, I'd be a very crappy person right now.
Well, hope everything's okay with you and your family. So let's jump in because I know you wanted to talk about new unemployment numbers or job numbers, I think, and you also want to talk about stimulus. So have at it. We appreciate your opinion.
Of course. So actually, the U.S. Bureau of Labor Statistics just released July's unemployment numbers. So it's a little bit encouraging. The jobless rate actually fell in July. It's down to 10.2%. To give that some context, back in April, the jobless rate actually hit a record high of 14.7%. And it's sort of been steadily declining since then. So in May, we had unemployment of a little over 13%. June was closer to 11%. And now we're getting down close to 10%. So on the one hand, that's good, right? Because
Yes.
we're seeing that number decline. On the other hand, you can't gloss over the fact that prior to the pandemic, unemployment was at 3.5%.
Yeah, amazing.
So when we take a look at July's numbers, sure, that's great compared to April, but when we compare to pre-pandemic conditions, we're clearly still in a pretty bad place, Jeff.
Yeah, no one's going to argue that, and especially when you were at basically full employment, and now you shed all these jobs. And quite frankly, Maury, we don't know if some of these small businesses that had to close are ever going to be able to reopen. So many small business owners had to close because of the shutdown, putting them out of business effectively. So that's going to have an impact on jobs as well. I still feel for all those people who are unemployed, they're looking for a job. They want to work. They're trying to work. They can't find something, and I think that's tough, not only physically but also tough mentally as well.
Exactly, and let's also not forget that the way they calculate the jobless rate is interesting. So one thing that they don't actually take into account when we're talking about unemployment, they don't take into account people who have sort of given up on trying to find work and aren't looking.
Yeah.
So basically, when we calculate the jobless rate, we're talking about people who are actively looking for work and people who are actively available for work. But a lot of people don't fall into that category right now because, for example, people whose jobs don't lend to remote work and who don't have childcare, if they've been laid off, they may have to give up on looking for work for a while until they're able to, get childcare again. And a lot of schools are not going to be opening full time, in the fall. So there's that challenge. And then the other thing to consider, and this is, this could be both a positive or a negative. There's millions of Americans right now who are furloughed.
Yep.
So, they're not working, they're not getting paid, but they're still technically, they're still, employees. Their fate could sort of turn the tides either way, right? If a lot of those furloughed employees get to return to a job in the next month or so, we'll see unemployment go down probably. But if they're not able to return to work, then, well, the opposite will happen. And that kind of ties back into those small businesses you were talking about, because a lot of small businesses right now are in limbo as well. They're waiting for more funding, which we'll get into in a minute. But, a lot of small businesses got relief with PPP loans earlier in the year. That's Paycheck Protection Program loans, a little bit of a mouthful to say.
Yeah, absolutely.
But but a lot of those companies have exhausted those funds by now and are waiting on a second round, and they may be unable to bring staff back in until they get that second round. So there's just a lot of businesses and a lot of people in limbo right now, which is why, while a decline in unemployment is obviously a good thing, I'm also not personally too excited about that. I think there's still, we still need to see what happens in the coming weeks and months for us to be able to say, oh, it's going to keep falling steadily through the end of the year.
Yeah. Well, Maury, there's a lot of uncertainty. You picked up on it. I think we all feel it. The market feels it. Individuals feel it. Families feel it. We have been, we're down this route where we're dependent on the government stimulus, right? I mean, we've gotten 2 or 3 rounds of that. There's been a lot of discussion out of Washington, D.C. We're recording this on Friday afternoon at 12:06 as I look at my clock. Any word on, has there been an agreement? I mean, I got to preface my question by, I hate the fact that we're dependent on Washington, D.C. for anything, especially, so for our livelihoods. But any word out of Washington in terms of this stimulus bill, any agreement at all?
There's word, Jeff, but it's not good word.
Oh,
So
that
basically,
sucks.
as you said, so far we've actually only gotten one approved stimulus deal. That was the CARES Act that went out back in March, and lawmakers have been working on a second stimulus deal, especially recently, given that the jobless rate is still high, and given that the $600 weekly boost to unemployment benefits that the CARES Act allowed for actually just expired at the end of July. So right now, people who are on unemployment are getting a lot less money, and they're going to start really feeling that pain soon if lawmakers don't act. So, so lawmakers have been trying to hammer out a second stimulus deal, and just last night, they sort of said that they're really just struggling to come to a consensus, and it's negotiations are effectively stalled. I mean that's what they said last night. And I'll tell you what the big sticking point is. I think one of the biggest sticking points is actually unemployment itself, because Democratic lawmakers want to see that $600 weekly boost upheld for the rest of the year, all the way into January of 2021. Republican lawmakers don't want that. They're saying that, because that $600 boost actually gives a lot of jobless people a raise compared to what they were earning formerly, they're saying that if we uphold that, it's going to discourage workers from going back to a job when one becomes available. So Republican lawmakers actually released what's called the HEALS Act in late July. And in the HEALS Act, they're calling for a $200 weekly boost for the near term. Mm-hmm. And then it would sort of convert to this formula where unemployment benefits could conceivably replace about 70% of a jobless worker's former earnings. So that's the proposal they're putting out. And, both sides just can't seem to come to terms on that. Democrats are digging their heels in. They want that $600 boost. They want to spend a lot more money on this relief package than Republicans do. So unfortunately, negotiations are stalled. And as of this discussion, there's also been no temporary extension of boosted unemployment. That's not good.
No, I'm sorry. I said that very in a sarcastic way. No, that is not good. Sorry, you couldn't pick up on my sarcasm.
Jeff, you're such a nice guy that it's hard to read sarcasm in your voice sometimes. But yeah, I have to tell you, I'm shocked at that. I am actually shocked that they weren't able to at least say, okay, under the CARES Act, the extra $600 a week expired in late July. It actually effectively expired around July 25th, 26th, because states pay unemployment on a weekly cycle, and that cycle typically ends on a Saturday or Sunday. So even though the CARES Act said that the 600 could stay in play through July 31st, it actually really expired about a week prior to that. So now here we are. Today's August 7th, and so now we're looking at a couple of weeks where there's been no boost in play. And I'm just downright shocked and appalled that they couldn't at least slap on a temporary extension to say, hey, okay, while we duke it out here, here's some money to keep you guys afloat. And it just hasn't happened yet.
Yeah, I think I share your feelings as well. I mean, while people are playing, and again, I hate the fact, and I want to preface what I said, hate the fact that we're dependent for our livelihood in one small area of the country. I mean, we're talking about 330 million Americans in this country, and we're waiting on 535 if you include all the senators, people to get their acts together. And really, that's not even a full vote. It's got to come out of committee, then get passed, then and probably go to a conference committee because you've got two different points of view, and then go to the president. It just seems ridiculous to me, but who am I? So I think people should call their lawmakers, spend time this weekend calling their offices, because I think they go on recess, right? I mean, I think they're on recess after this week. So
they're supposed to go on recess, but I'm hearing that may not happen.
Yeah,
because this thing needs to be hammered out. I mean, if we have to then wait for September for lawmakers to then get back together and start talking about this stuff again, I mean, we're going to have a crisis on our hands. I mean, we're going to have rent delinquencies, mortgage delinquencies. I mean, systems are going to crumble.
Yeah.
So I think it's safe to say we cannot wait another month here. And, another thing that's going to be part of this second relief package, there's going to be relief in there for small businesses. Republicans are actually calling for, and this is a good thing, I agree with this, they're calling for a second round of PPP loans.
Yeah.
The difference being this time they're calling for a round just for the hardest hit businesses. So in the first round, you could basically get a PPP loan as long as you certify to the fact that due to economic uncertainty, you needed the money. Now you actually have to prove that you've suffered a loss in revenue, which I don't think is a bad thing because unfortunately a lot of businesses did take advantage of those loose requirements during the first PPP round. But that's another reason why they need to get moving on this because a lot of these small businesses, they need that influx of cash. And not only that, but they need the money to prevent more layoffs and bring back more jobs.
Yeah, and interestingly enough, we did a story on the network. Apparently, a lot of the top 10 or 100 RIAs took PPP money, which I find very curious. But I agree. Look, we need to get the money where it needs to be. And, Mari, I just want to end by saying I think if people are as appalled as we seem to be, you can call the Capital switchboard at 202-2241. 224-3121. So that's 202-224-3121 and make your opinion known. That's what democracy and our republic is about, so people can voice their outrage. Mari, it's always a pleasure talking.
Absolutely.
Yeah, I'm sorry. Go ahead.
Yeah.
Mari,
Absolutely. Take a stand.
Absolutely. Mari, always a pleasure talking with you. Really appreciate your perspective. Really interesting stories. Let's get moving on this because I think a lot of people are dependent on it. Have a great weekend, and we'll talk to you again very soon.
Sounds good. Okay. Fingers crossed. Bye, Jeff.
Bye. Welcome back. Now time to talk social media trends. Joining me on the line, he is the Senior Financial Services Editor for LinkedIn. He's also the editor of the This Week in Finance newsletter, Devin Banerjee. Hey, Devin, how are you?
I'm doing pretty well, Jeff. How are you?
Doing well. It's sunny here in the eastern part of the United States in New York. How are things? What's the weather like in San Fran?
Pretty good. I'm standing in our backyard, and I've got the sun streaming down, so pretty nice weekend shaping up.
Well, good. I'm glad. We deserve it. It's been a long week for so many different reasons. And again, really appreciate you doing double duty this week, appearing on the program on Friday, and then you come on the podcast, which we record on Friday afternoon, which is really your morning. So, Devin, what's top of mind for you this week as we wrap up the week?
Yeah, absolutely, Jeff. A super, super busy week on the LinkedIn platform. A lot of conversation about different news topics. One of which we did go deep on the network in, which is e-commerce and online shopping really taking off. We got a lot of data and insights from a slew of recent earnings reports from the likes of PayPal and Shopify and Square, the card companies, Visa, Amex, MasterCard, and really, reinforcing the point that the acceleration of some of these trends we're seeing has just been brought forward by several years. So at PayPal, for example, Dan Schulman, the CEO there, was saying, it's not hyperbole that we've seen a 3 to 5 year acceleration in their business. That's just the math. So newly active customers there. So those who are, they think pandemic driven, has surged 30% in their second quarter. At the big payment processor, Global Payments, their share of online payments in their processing business is now 25% of their total. And their CEO, Jeff Sloan, saying that was always our plan, but that was our plan 2 years down the road. And so they've been brought forward 2 years in their business effectively. And, this is happening globally. I was reading an item that we featured this morning that's really taken off internationally, which is a report out from Facebook and Bain & Company about Southeast Asia, about 310 million consumers in Southeast Asia. That's about 7 in 10 people aged above 15 will have bought something online this year. And that's a number that these researchers predicted would be reached in 2025. We're in 2020. So this is a testament to that real exponential change caused by this pandemic. Now, what's interesting, which you and I touched on briefly on the network, is that, look, this is the share of spending online. But of course, at least here in the U.S., the overall, picture of consumer spending is still down from pre-pandemic levels. And there was a really, really interesting news item out this week about, if you go even deeper than that, the share among credit card spending and debit card spending, and how people are thinking about credit card debt. So according to Equifax, outstanding credit card debt balances actually fell by 11% from February to June. Numbers from the Fed show April saw a record monthly drop in revolving credit, and May was the second largest drop. And so, the data is actually showing that Americans are paying down their credit card debt. There's a lot of evidence showing that government relief programs and stimulus, those $1,200 checks, actually were funneled by people into paying down their credit card balances. And so that's actually kind of an optimistic sign, if you will. This is very different from the last downturn 11, 12 years ago. Typically when unemployment is soaring, credit card debt delinquencies are expected to surge. That's what happened last time. It's not actually really happening this time. So, people are pointing to, again, government relief, which is now back in the political arena and being debated. And so, hopefully that can continue to keep households and consumers on a strong financial footing. People are pointing to spending shifting more to debit cards from credit cards and people easing off of the borrowing cycle. So some good signs and a really interesting nuanced conversation there that really took off both on LinkedIn and I saw across other media outlets as well.
Yeah, one comment you made, and I just am curious about this, Devin. You mentioned, I think 15 years and older consumers were buying things. What did they buy them with? Do they have credit cards, or you have Venmo accounts? It just struck me as, I'm just thinking back when I was 15. Now, that was a long time ago, and yes, that we did have credit cards back then, but I did not have one as a 15-year-old. Any sense, any indication in the article?
Well, actually, yeah. If I click through on this report, which, as I said, was from Facebook and Bain & Company, which was about Southeast Asia, there are actually so many digital wallets companies and startups in that part of the world. We think there are a lot here in the U.S. When you go over to Asia, people's phones are connected to their bank accounts, or if you're 15 years old, maybe it's connected to your parents' accounts and your household accounts, but it's not that difficult to spend money, online in that part of the world or from your phone. And so I'm looking through at all of these apps, a list of them here. There's a diagram in this report over in Asia. And so, people have quite easy access to e-wallets, and their bank accounts are all connected to their phone.
Yeah, amazing. Absolutely. It shows you the interconnectivity, and even America's youth. Look, I mean, it's just a ever-evolving world. It just shows you why things have really picked up with the e-commerce, and it's amazing how now we're ahead. There, the e-commerce industry is ahead, of where they even projected themselves to be. Amazing, absolutely amazing.
Yeah, absolutely. So a couple other items I'll touch on. One which was a bit more light, although the substance of this conversation is quite serious, which is the pandemic workday getting longer? As you and I have talked about, the lines are really blurred between work and life as we're all in our homes or our apartments. And now some official data out from the National Bureau of Economic Research here in the U.S. shows that on average, people's workdays, Americans' workdays, are about 48 and a half minutes longer than usual, almost an hour longer than usual, and that's an average. So you can imagine on the different parts of the curve, there are people working a lot more. And let's see, it has about 13% more meetings, it has more emails. VPN data is also showing that people are really working at odd hours. And so there were a few people quoted in a Bloomberg piece on this, pointing to their harried schedules, their childcare demands, and just that blurring of the boundaries between work and life. It means people are working longer and at more crazy different hours of the day, logging on late at night or starting super early in the morning just to balance their schedules and their families and their households right now.
I'm not so sure that's a good thing. If you're working both ends of the burning at both ends of the candlestick, you're going to wind up with no candle. To use an analogy, I'm not sure it's a great analogy, but I feel like, with that time you saved in the commute, you just plugged right back into work. That's what most people in New York have, like at least an hour commute. So I'm not sure how that kind of does for mental health or physical well-being, but I guess an interesting stat.
Yeah. Absolutely. And last thing I'll mention, Jeff, a lot of and it's kind of related to the point we just talked about, what's on the minds of a lot of people, parents, most especially right now, is what is going to happen with schools. And so I think just minutes before you and I got on the phone, the governor of New York, Andrew Cuomo, announced that schools will be in person this fall in that state. And I know a lot of parents who I know in the New York area were paying close attention to that. But a lot of conversation on the platform about that this week, especially around a report out from the UN really warning about a, quote, general catastrophe, an education catastrophe because of school closures around the world this year. If you think about it, many students are missing out on a huge, huge chunk of their education, half a year to a full year. I mean, probably maybe more depending on how long this lasts and what the health and safety standards are in different parts of this country. But schools shuttered in more than 160 countries as of July. According to the UN, that affects about 1 billion students. And so they're calling this a learning crisis in the cards. And it's actually just an exacerbation of a learning crisis they had already deemed was occurring globally before this. So, a bit scary, a bit pessimistic, but if you bring it down to the human level, a lot of parents right now are just on edge about when their children are going to get back to learning full time.
But I think you had it right the first time, because now they are also being teachers. So most parents are acting as at least a proxy for teaching. So I think they're kind of working all ends as well. I think I've always said that beyond the first responders during this pandemic, the most impacted are parents, because they're doing so many things. And look, I mean, there's no perfect solution to this COVID crisis. You bring children back to school. You maybe put teachers at risk. You put families at risk. At the same time, you mentioned the potential deficit in learning, but let's not also forget about the social aspects of that. A lot of what you learn as a child is how to interact socially with other children. Even though people do use a lot of technology today, being able to interact with your friends, go play video games, a lot of times you're doing that together. So there's a lot of implications here. And the last thing we want is a degradation in the skill set of our future workforce, right? I mean, that's who these children will be. They will be the leaders of tomorrow, and we want them to develop and grow, and we don't want to be stunted in any way.
Yeah, that's a fantastic point. As you were saying that, I was thinking about one of my favorite movies, Minority Report, where it's a world where everyone's just interacting in these, virtual reality settings, and it's all kind of digital, and that's a scary world. And if students aren't out and about running around with their friends, right now, and maybe into the future, depending how long this lasts, I'm personally kind of scared of that.
Yeah, I think that's not good. It's an over pivot towards one side. We need to kind of get back in the middle. Well, Devin, always a pleasure chatting with you. Thanks again for doing double duty. Great to talk with you on the network and great to talk to you here. Lots going on the platform. Have a great weekend, and we'll talk to you again next week.
Sounds good, Jeff. Take care.
Snoop Doggy Dogg and Dr. Dre is at the dope, ready to make an entrance, so back on this. Before I have to pull the strap off the
Welcome back. Time to talk markets. Joining me on the line, he's co-founder of Delphi Digital, Kevin Kelly. Kevin, how are you?
Doing great, Jeff. What about yourself?
Doing good, doing good. And we survived the rain, and it's sunny out, and hopefully we have a very nice weekend with maybe cooler temperatures.
Oh, God, we can only hope, right?
Yeah, it'd be wonderful. So Kevin, let's talk about this week and try to paint a picture of what happened thematically, economically, but also in markets. How are you and the folks in Delphi seeing it this week?
So I think we're now at a really interesting point where, a lot of this, everything that you're seeing happening in markets, whether it's in the equity markets, whether it's in precious metals, you're seeing gold and things like silver really kind of explode and almost turn parabolic here. A lot of this really kind of boils down to what we've seen as of recent in the US dollar, at least in our opinion. And so if you're looking at some of these dollar indices like the DXY, that's one of the most commonly tracked, you've seen pretty much the dollar essentially almost fall off a cliff here. It's at its most kind of oversold levels that we've seen in the history of the index, at least on a short-term basis. And so what that means, or what we're kind of preparing for here, is if you do see a bit of a reversion or a reversal in the dollar back towards further strength instead of weakness, I think that's going to put a stop in a lot of these trades, at least in the short to medium term, like gold, like stocks. Because again, if you chart pretty much any asset at this point and you just put it against a chart of the dollar index inverted, they pretty much track each other 1-to-1 since we saw this kind of March slaughter within markets. And so right now, what's really kind of top of mind for us, and this goes beyond just traditional markets like equities and gold. This is, if you do the same thing with Bitcoin or the broader crypto market, a lot of that is less, I would say, less dictated by what's happening in traditional markets and currency markets. But Bitcoin specifically, I mean, you see very, very similar price action. I think, long story short, the biggest risk to, this resurgence of the everything rally, I guess you could say, is a stronger dollar at this point.
So a stronger dollar. What does that mean from an economic or, let's say, import-export point of view? I mean, because we're always hearing about that in the media about importing. We want to export more than we import, right? That's a big part of the president's agenda. But what does that mean overall? If the dollar's strong, what does that mean?
Yeah, so by and large, the global economy functions much better, or has higher levels of growth and therefore higher asset prices in an environment in which you have a weak dollar. And the reason for that is exactly what you were alluding to. When you have a really strong dollar, it puts a lot of deflationary pressure on the global economy. And for us in the US, right, especially for some of these multinational companies, a stronger dollar means that you become essentially less competitive with foreign imports, right? So now we would be importing more than we're exporting because foreign currencies are falling relative to our domestic currency. And so the dollar, normally the ebbs and flows of this, if you're talking about local currencies in other countries, it's more of a one-to-one relation. What's interesting about the dollar, though, is because as we've talked on your program, a bunch, the kind of dominance of the US dollar, whether it's in global trade, transaction values and settlement, and just the amount of dollars that are held as a safe haven kind of reserve asset, there's a number of different factors that kind of play into what influences the dollar direction, right? But essentially what it boils down to is a stronger dollar tends to be a cap on global growth. And so this weaker dollar play is a lot of people essentially, one, coming out and expressing a view that monetary policy and fiscal policy, essentially almost, calling BS on some of the monetary and fiscal policy that's happening right
That's
now.
technical. That's a technical term. That's a finance term.
That's the technical term for it, at least relative to some of these other countries. The other is also a kind of implicit bet on a resurgence in global growth, which again, sure, we get into the jobs number this morning here in the U.S. or some of the other economic indicators we're seeing across the global economy that could give you an indication that things are improving. But I do think it's really important to note that we still certainly sit in the camp that this is going to be a lower for longer, slower type recovery. And I still think that, a bit of dollar strength here, just given we're certainly not out of the woods yet, is, more my base case than the dollar continuing to trend lower. I think over the long term, there's a lot of structural potential issues or reasons why we think the dollar is going to be kind of dethroned or weakened considerably. But in the short term, again, I think there's a lot of headwinds we still face from a both domestic and global economic standpoint that could potentially give the dollar a bid.
Yeah, well, more to certainly come there, and I think it's changing day to day, hour to hour. second to second. Let's talk a little bit about cryptocurrency, because my understanding, and I want to get your thought on this, is that there may be some seismic shifts occurring in the crypto market, with stable coins in particular. But how are you guys seeing the week that was, because the week's over, basically. It's 1:22 Eastern time, but how are you guys seeing what's going on in cryptocurrency?
Yeah, the top level, or the top of the funnel, I guess you'd say, Bitcoin has certainly played catch up to its, physical gold counterpart, I guess you could say. BTC breaking through and still holding above, around 11,600 now. So that's been a pretty big move to the upside, taking a quick breather. Certainly think that, again, depending on how this whole dollar kind of global macro plays out, you could see a bit of a pullback there. But the broader crypto space continues to not only innovate and heat up, but there's a lot of interest getting driven into this decentralized finance sector, where you no longer, I think the misconception of the 2017 ICO days, where you just had a bunch of projects listing tokens that had very, very little evidence that they would have a use case that could actually accrue value long term. Now you're seeing a shift towards capital becoming more disciplined and going into projects in which you can actually see a viable use case. And what's interesting about this whole kind of DeFi movement is that a lot of these projects that we recently just launched a venture fund, and we've backed a few projects that don't necessarily take an influx of new kind of users or mass adoption, I guess you'd say, or mainstream adoption for them to be successful or have their projects and their native tokens or digital assets accrue value. And so what you're starting to see from an investor perspective is a lot more discipline around where capital goes. Now, within these kind of hot sectors, as you would expect, similar to tech investing, for example, there is a lot of money being thrown within that sector at different projects, and some of which maybe we're not as bullish on, or we wouldn't be as favorable on as some other ones that we've actually personally invested in. But long story short, that sector itself, I think the fact that a lot of capital is gravitating towards it shows that people and investors are being more disciplined in terms of where they put their capital. Now, which company or which project is kind of the end all be all in some of these categories is still obviously to be determined. But that is kind of the big kind of structural shift that we're seeing.
And then in terms of the overall technology, the blockchain, I read, I'm going through articles every day. I see blockchain more and more mentioned in other industries. How mainstream is that technology, would you say, in terms of the enterprise, where it's being used, et cetera?
Yeah, so enterprise continues to be. I would say, if you're thinking about a graph of adoption over time, and I just mentioned this whole DeFi movement, I would say DeFi is kind of almost turned parabolic. It almost looks like a silver chart, right? Where you're seeing a ton of people come in, really interesting. The enterprise side of things has continued to steadily grow, and it continues to grow. But I do think that, from an investment standpoint, I think a lot more attention is starting to be put on these really kind of novel ways in which you can use blockchain technology. Because again, and might just be my bias, because a lot of our work, pretty much all of our work, focuses on the more public blockchain space and not so much the private space, private blockchain space. I just find the novel ways of public blockchains and the projects building on top of them much more novel and unique and original than basically recreating internal databases in a more, we'll call it, decentralized way across maybe a cohort or a specific industry, number of industry participants. So enterprise continues to grow. We still have partners who focus exclusively on that. So if anyone's curious, obviously we can point them in the right direction. But for us, the public space is a lot more where I think you're going to see really true value start to accrue to, and people really wake up to the opportunities.
Man, it's just fun. It's interesting to watch. It's fun to kind of follow. And the more I read the news and articles in business, et cetera, the more pervasive it is, and it's finding its way into all different types of things, from airline industry to healthcare to, it's already in finance and other places. So really interesting to watch. Kevin, always a pleasure chatting with you. Thanks so much for your perspective, and take care of yourself. Have a great weekend. We'll look forward to talking to you soon.
Absolutely. You too, Jeff. Have a great one.
Bye.
Thanks.
Welcome back. I'm going to check in with the lead anchor for the TD Ameritrade Network, what he took away from the trading week. He works on two different shows for the network. I'm talking to Oliver Rennick. Oliver, great to talk with you.
Thanks, Jeff. Appreciate you having me as always.
It's always great to talk with you, and you bring such a really interesting and unique perspective to covering the market. So how did you see the week play out? I know today we got jobs numbers, but in total, what did you see?
It was more of kind of this back and forth. The market has been toying with the idea of being more oriented towards economic centric companies and sectors. And we got a little bit of that on Friday. And that it was kind of through some of the other trends for the week, which were big tech leading and all of the overall trends of really kind of the last month and a half, kind of threw some of that into question.
Mm-hmm.
We had a good beat on the data, which should have some response in markets that is, cyclically oriented, meaning economically sensitive groups in the market should do well after something like that. You should have a drawback in some of the things that people consider to be hedges for economic risk, like bonds or gold. And we did end up getting that on Friday, which was good to see the market respond to this unemployment beat. But it's really taking a lot to cause this underlying rotation potential to really pick up steam. And that's really what we've spent the last almost 3 weeks now watching in the market, is the leadership between the tech-heavy NASDAQ and the idea of value or economically sensitive groups that you can kind of look at through the Russell 2000, small caps, domestic companies, et cetera. And it's really gone back and forth. It just constantly has been this ping pong for about 3 weeks, and neither has really made a decisive move. And it's really important because if we are turning the corner in terms of fighting the virus and having the economy reflect that in a positive way for growth, then you would expect this rotation to really take hold. So it's kind of this back and forth reflects the market's still, worries and kind of uncertainty about the economic situation and the rate for recovery. But the good thing is, in the meantime, when the market's not confident about that type of recovery, then they basically just continue to pile into tech companies as this sort of, a safety play in a way in the stock market, because these companies, have so far, been able to do no wrong from a return standpoint. But at the same time, this past week, we saw gold break out again, bonds break out. So the tension is definitely building here, where that using stocks as a safety trade may not make too much sense, if there's going to be another big gap in the economy or something. So it's basically tension in markets still without a lot of solution, to be honest, without a lot of clarity.
Oliver, typically, let's say that there wasn't a pandemic and this was a typical summer. Is trading typically light during the summer months?
It is.
In August and July, and then after Labor Day we get another run again. Is that typically what would happen?
Generally, you think of volume being low in the summer. Yeah, that's generally the idea. Yep. And also, as we heard the case this week from Ari Wald, who was on the show from Oppenheimer, really good market analyst, was also saying that traditionally August is a little bit of a weaker month for stocks.
Yeah, and so we would expect that. But I guess with the pandemic, there's a lot more happening, a lot more volume. People are kind of recalibrating, look at their portfolios, for lack of a better term.
Yeah, exactly. Yep, pretty much.
And
there's a lot you got to try and figure out right now, and nobody really knows. Nobody has a lot of confidence in betting on any change in the trend. So the key point is that there's this potential to bet on change, which is acceleration of growth represented by this rotation. And some people are trying to do that, but the majority of investors are still basically standing by what's worked, which is big tech, bonds as the Fed keeps rates low, and expecting more stimulus essentially. And the bottom line is that adds up to market positive, and so we're now below the all-time record for the S&P. Like we're very, very close to it now, only 30 points away.
I mean, it's just amazing, right? I mean, you just talk about just, from an editorial perspective, it's just amazing how resilient the market has been. And remember, it got down to like 19,000, right? I mean, when you look at where the Dow Jones was, I think right when this pandemic first hit, I mean, we had lost significant gains. And now all of a sudden things have kind of roared back. I find that just amazing. And again, a lot of it seems to be on the back of the technology sector. But it just shows the resilience, in my opinion. I'm not putting words in your mouth, but it just shows the resiliency economically that, of how we can kind of weather some storms, even though it's been challenging.
Yeah, it has been. And the surprise to which Americans are largely weathering these storms has been a really key part of understanding why the stock market has done so well despite these problems with the economy, because they're still getting checks. Incomes actually on net after stimulus were higher in the months following the crisis. So even 10% unemployment is being papered over. The question is how much real recovery, if you think about like a Band-Aid where the stimulus is the Band-Aid, how's the wound underneath healing, and when we take it off, how bad is it going to be? Are we at the point where we can take off this Band-Aid and just kind of, let it air dry its way back to normal? Or, are we still going to find a mess under there that is needing help? And it's probably closer to the latter. We heard on Friday from Neil Dudd at Renaissance Macro that there really is still a need for fiscal extension of support, or else you're going to have wounds that fester.
Yeah, I think you hit the nail on the head. We're down the path. People kind of expect the government to kind of intervene because it's already done that. So you can't just pull the rug out from people's feet. You're going to have to wean them off of that, and to just not come to a conclusion or an agreement, I guess, between the multiple sides within the House and the Senate. Obviously there's some expectations here that have to be met. So I guess we're going to see how it is. Oliver, always a pleasure chatting with you. I always love the conversations, the thematic conversations, and how you bring it all together. And people certainly should check out Oliver every weekday. You're on in the morning and in the afternoon on the TD Ameritrade Network. Check him out, Oliver Rennick. Great talking with you. Have a great weekend, and we'll talk to you again very soon.
Thanks a lot, Jeff.
Bye-bye. Welcome back. Now time to talk a little real estate. Joining us on the line, he is the real estate reporter for Dow Jones Market Watch, Mr. Jacob Passy. Jacob, how are you?
I am doing as well as one can amidst quarantine. How are you?
Yeah, I'm doing okay. About the same. And a little bit of a rainy week this week. A lot of storms in the New York Northeast area, so it's kind of digging out from that. But a lot of great stuff going on. Some good, a lot of stuff going on. Some good, some bad. So always love chatting with you about a lot of different topics. But I wanted to kind of zoom in on real estate. What do you got for us this week?
Yeah, so working on a story right now, looking at the situation with the looming eviction crisis in the country. As listeners may already know, many eviction moratoriums that were established at the beginning of the pandemic have since expired, especially the federal eviction moratorium that was enacted by the CARES Act that expired at the end of July. And, lawmakers are still debating things. And so there's not been any movement yet on a new moratorium at the federal level. And then certainly, states and cities across the country that had originally, banned evictions, those bans have ended. So a new report that came out today on Friday from a group of housing economists and researchers and academics estimates that between 30 and 40 million people across the country will be at risk of eviction in the next several months unless, major action is taken to, prevent that from happening.
So what is our expectation here? I mean, a lot of this is on, I live in New Jersey, you live in New York. I know the governor of New Jersey had passed some executive orders kind of pushing off evictions. That has ebbed. But is this something that has to be done at the local level, or can there be things done at the federal level?
Yeah, so at the federal level, there was an eviction moratorium that applied to a broad range of housing. It applied to basically any form of rental housing that had some sort of federal backing, whether that was, HUD grants. There are still eviction moratoriums in effect for properties that are backed by Fannie Mae and Freddie Mac loans and FHA loans. So, landlords, small mom and pop landlords or multifamily landlords who own properties where they've received forbearance on their mortgages. They are not allowed to evict their tenants right now. But, the federal moratorium that was in place because of the CARES Act did, leave out a broad range of rental housing. And so some lawmakers have called for a national moratorium that, applies to all forms of rental housing. The challenge, though, which, a moratorium like that would be great for renters. It's, sorely needed. I've spoken with renters who, are, at risk of losing their homes. One woman I spoke with this week, had to move to working part-time because she's a single mom and raising 2 kids, and childcare is expensive, to say nothing of the fact that it's difficult to line up in a safe manner right now given the pandemic. You can't just welcome anyone into your home to take care of your kids. And then she's looking to the, school year where, it could be virtual. And, she wasn't working a job from home. She was working at a store. So, in her case, she couldn't just leave her kids home alone. So she ended up having to move to part-time work. And is doing things like donating plasma just to be able to afford her rent. Because as she points out, if she loses her home in the midst of a pandemic, it is her whole family will be at significantly higher risk of contracting COVID-19 without, a safe place to stay. The biggest protection we can take right now to prevent the spread of this virus is to stay at home. But if you don't have a home, that's impossible. But the situation's also bad for landlords. A lot of landlords have been up in arms over some of these moratoriums because they have not come accompanied with forms of rental assistance or financial assistance for the landlords themselves. In a situation where you have a mortgage, if you're a landlord with a mortgage, you might be able to push off some of your financial responsibilities by getting forbearance. Mm-hmm. But if your, tenants aren't paying, you're not receiving, funds that you need to use for upkeep, for, any sort of costs associated. And a lot of, almost half of the rental properties nationwide are owned by small mom and pop landlords who only own, 1 to maybe a handful of properties, So those folks don't necessarily have the, savings and financial backstop to, cover months and months of expenses without rental payments. Yeah. So it's, even if a national moratorium were put in effect, there will still be a ripple effect across the economy caused by this housing crisis.
Jacob, are there parts of society that are overwhelmingly impacted by what's going on? I mean, I would think that the lower income folks maybe are at a distinct disadvantage here. I mean, is it your sense, based on who you're talking to, as writing this article, that could be the case?
Yeah, no. So you're exactly right. Folks who are in the lower income, spectrum are certainly at more risk, and people of color are at a disproportionately high risk of being evicted. Census Bureau survey data shows that more than 1 in 4 Black renters missed last month's rental payment, and another 1 in 6 renters said they had no confidence that they will be able to pay the following month's rent. Mm-hmm. So, in communities of color, Black Americans, Hispanic Americans are, at much higher risk than white Americans of, being evicted and becoming homeless because of, the fallout from this crisis. It's folks, commentators have been pointing out that the pandemic has really exposed the inequality in our nation's housing market. You and I talk all the time about mortgage rates. And so if you're a homeowner, and you probably haven't lost your job because, a lot of the job losses that occurred because of the pandemic were in lower wage jobs in the service sector. And, those are folks who are more likely to be renters than homeowners. So homeowners, millions of homeowners were affected. I don't want to, act like no homeowners were, mm-hmm. But also, homeowners, if you have a mortgage, chances are you can get forbearance right now and skip payments, and that doesn't affect your credit score, and you're not at risk of becoming homeless. And you can do that for up to a year, whereas a lot of these moratoriums on evictions for renters were lasted for only a few months. At the same time, if you're a homeowner right now and you haven't gotten forbearance, mortgage rates have dropped so significantly throughout this crisis that you could very well refinance and actually save on your housing costs, which is not the case for renters. Leases are, rental payments are going down in many parts of the country because of, people leaving major cities and stuff like that because of the pandemic. But for, folks in the lower income spectrum, they are still very much cost burdened by, housing. And it just kind of has exposed this big gap in our nation's housing market.
Yeah, it seems like there's just so much pressure. I mean, you're talking about real estate, but there are other parts of the economy that have put a lot of pressure on those who are at the lower income part of society. It seems like, I know that in another segment we talked about this congressional stimulus, trying to get that extended, the PPP and some other things. It sounds like this is something that possibly needs to be taken up as well.
Yeah, when we talk about the PPP, that had housing, had an effect on the housing market in a sense, because a lot of landlords were not able to get a hold of PPP loans because they don't necessarily have payroll. And initially, the PPP program was, directed towards small businesses to, rehire staff. But if you only own a couple, real estate properties, you may not have much staff on hand. So, these loans were harder to get. And certainly, the expanded unemployment was a major boost to renters across the country. And, there were certainly lots of folks who only managed to keep their housing because of the expanded unemployment. So when lawmakers, that collapsed, and so those payments aren't, those folks may still be receiving state unemployment, but it's at a much smaller amount than they were receiving, a few weeks ago. And then, when you talk about lawmakers discussing different ways of changing the unemployment system, such as, there's been the proposal of capping it to 70% of your income, which would require kind of major overhauls of how states determine who qualifies for unemployment and major overhauls of these computer systems. That will delay things even further, meaning that these renters who are at risk of eviction, could face eviction well before they receive the benefits of the expanded unemployment once it's renewed.
Yeah, well, certainly Congress needs to be acting. State government need to be acting, because there's a lot of implications here. Well, Jacob, we're going to see you again tomorrow morning on BRN AM. Really looking forward to the conversation about mortgage rates and travel. Looking forward to talking to you then. Until then, enjoy the rest of the weekend. We'll talk soon.
Yeah, talk soon. Take care.
Bye. Well, that wraps up this episode of the BRN Sunday podcast. I want to thank all of our great contributors who donate their time each and every week to help us analyze and understand all the news in so many different areas. And I want to thank you, the audience, for whom we are incredibly excited that you join. We hope that you take a lot out of what we're doing each and every week. Don't forget, we're back again tomorrow morning on BRN AM. I'll be joined by Market Watch's Jacob Passy. We'll be talking about mortgage rates and also reopening of travel around the country. So hope you can join us. Until then, I'm Jeff Snyder. Stay safe, keep on saving, and don't forget, roll with those changes.